Hey, what's going on, everybody? Max here with BB, and today for 10 Minutes Max, I'm going to be providing a general market update. A lot has happened since I last posted a video. Of course, you guys, you catch a lot of the daily streams, Market Check, which we do Monday through Friday, but since I've actually uploaded a video, it's probably been about a week and a half. But just a quick reminder, it takes a lot more time and effort to upload these YouTube videos, so I can't get to you guys as often. But if you want constant updates as well, my Twitter, if you don't already follow it, is linked down below. I post there all the time. It just takes a second for me to post a chart, send out an update, a thought like that. So if you're not following my Twitter, definitely consider doing that because I can post a lot more high frequency. But let's get into it, guys. I won't waste any time. I'm going to try to keep it close to 10 minutes, but I'm probably not going to be able to do that. So I did a lot of like kind of repositioning right before this last drop. I took to Twitter. Some of you guys probably sniffed it out early. We got a pretty surprising U.S. unemployment report. Unemployment in the U.S. came in hot, which we talked about in my last video, where we had FOMC, we had initial claims, and we had U.S. unemployment, all like a triple header back to back to back. I think it was Wednesday through Friday. And we were talking about how in order for us to stay like higher time frame bullish, the ideal conditions, right, historically have been Fed's going to lower interest rates, but that comes in tandem with the labor market refusing to deteriorate, right? So you're basically getting mean reversion cuts. And, we're getting into that period of time when the Fed is expected to cut rates in the middle of September. And we got a bad unemployment print. So 20 basis points hot, higher than expected, right as we're getting to the very tail end of the Fed cycle when they start cutting, which, a lot of people get spooked by that. And then they go, okay, well, that's now implying to me that they're going to have to cut not just by a little bit, but do emergency cuts because the labor market is deteriorating. So that was basically what, in my opinion, sort of caused this reaction. But looking at it from a technical perspective, right? We're going to talk about all this. I was looking at this the night before. I was looking at this price action the night before. And by the way, this is the VIX, right? So the volatility index for the S&P 500. I was looking at this and I was like, okay, something is a bit goofy here. We were like hanging out right here. And I had this gut feeling about the U.S. unemployment report. And basically, I took some profits on, some smaller positions that I had, stabled up, and also put on some short hedges, and they ended up working out pretty well. If you're in the Discord, obviously you got updates, the entire way, like positional updates and changes. So I know a lot of you guys jumped on them as well. But I would say did a pretty solid job, like closing hedges and then getting fully deployed back into the market down in this region. But it's pretty crazy to actually see how we are, in fact, doing this COVID fractal, right? And the VIX spiking to 65 is actually an additional point of confluence for this market is once again way out in front of its skis. This happened over here, and I'll put the effective federal funds rate down below. You can see this is the effective federal funds rate. This COVID drop and this VIX spike, above 80 or whatever it went to, looks like it went to about 86, happened during emergency cuts during COVID, right? This most recent VIX spike over here to 65, right? To 65, put the effective federal funds rate on this side as well, has still happened while we're in the Fed pause. Like we're still paused. You can see, we hiked, we're paused. This cycle has been one of pretty obvious front running. Like no question about it. Bitcoin made an all-time high before the Bitcoin halving, and markets become increasingly more forward-looking and more reflexive, right? Like if you had told me a week ago, 3 weeks ago, hey Max, the VIX is going to spike to 65. What do you think the S&P 500 is going to do? I would have told you, hey, I'm probably expecting the S&P 500 to drop like 20%, 15, 20%. That's a crazy volatility blowout. Like let's actually just take a moment here and we're going to look at this because I want to put this in proper context for you guys, right? Like the drop that we had was historic, okay? So let's put the VIX down below. Here's the VIX. We'll put it on the candles just so we can get all the data, and see if we can do the monthly. So right here, this was the dot-com crash. This was the great financial crisis. We had some, like little bear markets and stuff, in 2015, 2016, bad years. We obviously had COVID, 9% CPI, and, fastest interest rate, hikes of all time, fastest Fed tightening cycle of all time. And we had last week, okay? So look at the VIX down below. In the past few decades, let's see how many times, let me go a little bit lower here, actually. Let's go to like the 3-week. Let's see in the past 2.5 decades, how many times we've had a volatility blowout and a scare like we had last week. 1, 2, 3, 4, 5, 6, 7, 8, 9. Less than 10 times in the past 2.5 decades, 25 years, have we had a volatility blowout and a shakeout like what we just had. Now, let's put these dots on the S&P 500 as well, okay? If you had been buying, actually, I should probably put them because it's to the downside, right? Put them down below. If you buy every time the VIX has a volatility blowout, let's see how that would have worked for you buying risk assets. Which stocks are risk assets? Like, there is no other way, or like that's what they are, right? A lot of people think stocks are like, like safe. It's not. They're risk assets, okay? So if you had bought every single time in the past 25 years, if your only trigger for entering risk assets, being stocks, over the past 25 years has been a VIX spike, basically above 45, give or take, this is what it would look like. You would have bought more or less within reason every high time frame bottom, and over a long period of time that would work out well. So there's something to be said about buying risk and jumping into the market when presented with a scare like the one that we saw last week, right? And I wasn't expecting a VIX spike to 65. That's crazy to me. Like that, the fact that we tag 65 is unbelievable. But this goes to show that like this June of 2019 fractal, which ultimately led into March of 2020 in the COVID crash, one, structurally, like these look the same. And two, like, you buy when the VIX spikes to 65 and you see that degree of fear in the market. It's that simple. Like I just showed you the chart, like that's what you do. That's the best time to buy. And it's possible that this market is forward looking so far that it's already sniffing out like higher than expected unemployment and more macroeconomic deterioration, and it's trading 2 or 3 or even 4 years in advance. I don't know exactly, but I mean, you can see like how quick these dips get bought up, right? Like, perfect example here. S&P 500 during the dot-com crash dipped 50% over like 3 years almost, okay? 1,000 days. And the VIX spiked to 45. Great financial crisis. Stocks dipped 58%. VIX had a blowout to 90. This happened in a year and a half. Okay. All these little blowouts while in an uptrend, right? We're probably doing like one of these, like intra-cycle kind of blowouts or whatever, where you get a big VIX spike, but then you just keep going up. But like look at the COVID crash, right? VIX spikes to 90 or whatever. Stocks go down 35% in 2 months and then V recover. Just recently, the VIX spike, like you have to go to lower time frames to even see it. VIX spikes to 65, and right now, stocks are 6.5%, 7% off their highs. This market is becoming increasingly more reflexive and forward-looking, clearly, and that's measurable by the pace of the buybacks, right? Like we haven't had these long, drawn-out recessions. Not that we won't ever get one again, but I mean, you can tell things are a little different, right? Like things are different now. Like these sharp moves are different. So let's talk about Bitcoin and Ethereum and what potentially happens next with crypto. Let's go to let's do this. So we're gonna actually pull this up here. We're gonna pull up the Bitcoin chart. We're gonna pull up the ETH chart, CME Futures. Okay. So Bitcoin had a pretty large CME gap, right? Obviously, well, not obvious for a lot of you guys. Maybe this is newer. But CME Group, they offer a futures product for trading basically paper Bitcoin and paper ETH, and they have like a 95% fill rate, or even a little bit more, over a long period of time. Like these CME gaps fill, it's kind of nice. So anyways, Bitcoin came back, filled in its CME gap. ETH has yet to do that. That's at about 3,000. Okay. I would be looking for that to fill for ETH, at some point. Like we'll see. It doesn't have to happen immediately, but I would expect both of these gaps to fill. I really would. So let's take a look at USDTD, one of my favorite charts. Crazy move. Another crazy move. Looking at this chart, guys, this has a negative correlation with crypto, right? It's like if we put Bitcoin down below, you can see pretty clearly here that when Bitcoin moves up, tether dominance moves down, right? Same thing here. Bear market for Bitcoin, bull market for tether dominance, okay? Perfect negative correlation. The implication there is people, they redeploy tether into volatile crypto assets, all right? Although it was a pretty wild move here, right? Like this was crazy. It was technically, depending on how you want to look at this, a nice little retest of this breakdown spot. Certainly more aggressive than I would have liked. But what we're looking for at this point, like let's actually flip the chart just for perspective. What I would be looking for or hoping for at this point would be like, this needs to move up like this. We need to see this breakout here. Nice trend line, finally broke out of it, got a very aggressive retest. You want to see this move up like this, okay? You really do. So watching that closely, just as an additional point of confluence, but today's Friday, so we'll see what happens. Usually not the best price action on Fridays, but anything can happen. All right, let's take a look at ETH BTC. BTC basically had like a monster capitulation, of course. Can't seem to find its legs, but the more I look at it, it's actually kind of an interesting little pattern here where we basically ranged like right in here. We were ranging for ETH BTC for like over 6 months. And then we just kind of broke down right now. And that's actually exactly what happened over here before the final capitulation. Now, what's interesting about that as well is if I pull up Bitcoin, we were just talking about that June of 2019 fractal. And this is the June of 2019 region over here, leading into COVID. And you can see that once that COVID drop happened, that was the bottoming region, like deep value for ETH BTC, this pair. And going back over here, right? Like this is the chart, right? This is June of 2019. There's COVID crash, VIX spike. Looks like the same thing, big huge VIX spike. Now going back to ETH BTC, I mean, this is where it is right here, and this would be your sort of bottom accumulation range before ETH eventually and gradually begins to outperform that of Bitcoin, right? Now I can remove this. We'll remove these drawings, and I'll just throw the VIX on there as well, just to show you. And you can see, and I got to put candles on because it doesn't show the close, but you can see like, buying ETH BTC during that period of time would have worked out pretty well for you during that, the VIX blowout, basically. So here, you can actually draw little trend lines in this. I actually like to do this quite a bit. But looking at it this way, if we're doing something like this and this VIX blowout, which has been historically a pretty decent time to actually buy into risk, well, here you go. We're down, kind of printing that same pattern. 3 drive into the low, deep value, VIX blowout. It's possible, right? It's possible the market is forward looking enough to kind of sniff this out. And we'll see what happens, right? But just showing an additional point of confluence. I think the PEPE is at a very interesting spot here, right? Like I'm looking at this PEPE chart, and we deviated below this last low here pretty aggressively, and we have bounced hard off of it. I would watch closely. Like, in my opinion, you're going to need to see obviously ETH strength in order for your ETH beta to perform well. You're going to need and want that ETH CME gap to fill over here, and then you'll get a big bounce out of ETH beta. But I don't think this looks too bad, right? Like all of this region You know, we deviated below all of that. Like this could in fact be deviation, maybe coming back like this. And you should really, if you're bullish market wide, you should be expecting um, a V recovery, right? And actually, let me show one more example here. Let's pull up the NASDAQ. I'll show two more examples, okay? So here's the NASDAQ, and we'll put up Bitcoin USD. All right. So what you should be looking for at this point for Bitcoin is more or less this fractal on the NASDAQ. I know some of you follow Jackus. He's on our team. He called this out a while ago, and it seems to be playing out pretty well so far. Like definitely some work to do, but like you should be expecting this right here. It just had this like 1, 2, 3, and then 1, 2, 3, same kind of move, right? Like this should be your base case at this point, and you should be expecting a V recovery if you're going to be bullish here. You should be. And one other fractal that Jackus actually pointed out is, let's see if I have it up here. Yeah, this is one of my favorites. So he's kind of like the fractal king at this point, but very interesting similarities between some of these old equity charts, with some of these old equity charts and ETH, right? And actually, I'll just do two of them at a time. So here's Amazon in 2010. This was a pretty incredible one here. Really interesting to see the similarities, right? Of if you had bought this drop for Amazon in 2010, what would have happened afterwards, right? So obviously it's never the same, but certainly there's something to these fractals. Like you see them play out time and time again. So interesting to see how, you know, it came down to this significant level, this trend line, right? And then, you know, I can look and pull up the NASDAQ here, just generally, like not a NASDAQ company, but like literally the NASDAQ. And you can see how interesting this fractal is with even the price that ETH topped out at in last cycle and then bottomed out in the bear market. NASDAQ was at 800. ETH was just over 800. Similar topping, then similar structure over here. Similar drop, like this would arguably be this drop back into mega demand and then, continues upwards. It's never perfect, right? Take them all with a grain of salt, but really interesting to see, right? I just am trying to fly through a lot of different examples here to provide some context. But anyways, guys, that's it. Like I'd say I'm cautiously optimistic at this point. Like I've began to redeploy, and kind of take some more stabs here at the market. I was de-risking and hedging a little bit, but when you see a VIX spike to 65, I hate to even say this, right? Because, it's tough to do, but like sometimes you got to take a shot. You see a volatility blowout like that, you got to take a shot. And, I'm taking some shots here for sure. But yeah, anyways, I'll wrap it up there. Follow me on Twitter. I'm going to be following all this pretty closely here because we are coming to some inflection points. But I'll start making some more videos here. It's been a little bit tough, like been traveling and stuff like that, but trying my best to update as much as I can, especially as we do our daily YouTube show. And you guys, I'm sure, follow me on Twitter, so you see it all there. But yeah, guys, thanks so much for being here. Help us get to 20K. Please consider liking the video and also subscribing if you are new here. Last but not least, if you want even more updates beyond YouTube, which is the least frequent, beyond Twitter, which is pretty frequent, but then even more than that, if you want to see behind the curtain, know everything that I'm doing, all my positions, hedges, buys, everything like that, definitely consider checking out the first link in the description below where you can join our Discord, guys. We do 2 hours a day of private live voice calls with me and the entire BB team and community. We share active positions, charts, premium analysis, things we don't talk about here on YouTube or on X. And within the next couple weeks, you're going to get free access included in your membership to our new flagship product called the BB Terminal, guys. It's got portfolio tracking, derivatives data, heat maps, literally everything that you could want or need to succeed in these markets, all bundled into one neat and tidy and convenient package, guys. Definitely consider checking that out. It's awesome. It's awesome. And it's coming out within a couple weeks. Really excited about that. Also, check out the second link in the description below to the BB Academy if you want to speed run your educational journey towards understanding these markets from a technical and fundamental perspective. Me and the BB team spent about 6 months compiling very neatly all of our most effective strategies that we use on a daily basis to navigate these markets, guys. A lot of people teaching TA out there, some for free, some paid. Some people do it really well. Some people feed you garbage. We can save you a lot of time, energy, effort, learning the wrong stuff. We conveniently package all of the right stuff. So support BB, support your trading journey. There's no better course out there, guys. We're really proud of how it turned out. So check that out. Second link in the description below. But guys, thanks so much for being here. Please like and subscribe, and we will see you next time. Take care.